Most investors think gold moves when people get scared. That is only part of the story. What I see now is more serious than fear. Gold moved first, silver answered later, and together they sent a message about trust. The message was not about a bad week in markets. It was about the system under the market. If you care about seeing these signals before they turn into public panic, stay close to me here, because this is one of those moments when the quiet move matters more than the loud headline. I have spent my life studying how money behaves when debt gets too large, when politics gets too tense, and when the people holding the biggest pools of capital begin to doubt the promises behind paper assets. Paper assets are things like bonds, currency, and many financial claims. They work well when trust is strong. They start to shake when trust gets thin. That is why I do not look at gold as a shiny object or some old world relic. I look at it as a report card on the quality of money and credit. Credit is borrowed money built on a promise to pay later. When gold rises for the wrong reason, it can fade. But when it rises because the plumbing of the system is changing, I pay very close attention. And silver matters too, but in a different way. Gold is the first move of caution. Silver is what often happens when that caution begins to spread. Gold is where central banks, large funds, and people thinking about reserve safety tend to go first. Silver is where the move becomes more emotional, more public, and sometimes more explosive. That is why the signal most investors missed was not just that gold was strong, it was the sequence. Gold acted like a warning light. Silver lagged, then started to wake up. When those two metals move in that order, I do not see a simple trade. I see the market telling me that the concern has moved from the edges of the room into the center. Most people will say this is just about inflation. Inflation is when money buys less over time. Yes, inflation matters, but if you stop there, you miss the larger machine behind the move. Gold and silver are not only reacting to prices in stores, they are reacting to debt pressure, policy pressure, reserve pressure, and the growing sense that governments are trapped by arithmetic. That arithmetic is simple. Debt has grown faster than income in many major economies. When debt rises too far, leaders are left with a few ugly choices. They can cut spending hard, which hurts growth. They can default, which means they fail to pay in full. Or they can print and devalue, which means the money gets weaker, so the debt feels easier to carry. History tells me what usually comes next. Governments almost always choose the path that looks easiest in the short run, even when it is painful in the long run. They lean toward lower real rates, more liquidity, and softer money. Real rates are interest rates after inflation. If your savings earn 4%, but prices rise 3%, your real gain is only 1%. Now pay attention to what made this move different. Gold did not only rise because rates were low, it rose even in periods when real yields were not behaving the way old models would expect. That matters. It tells me gold is no longer reacting only to the usual things like rate cuts. It is reacting to a deeper shift in trust. If you want a simple test for your own thinking, ask yourself this. If the assets you call safe are backed by governments drowning in debt, how safe are they really? I am not saying bonds disappear tomorrow. I am saying the market has started to rank forms of safety differently. A bond is a promise from someone already carrying a burden. Gold is no one's promise. Silver is no one's promise either. That difference becomes very important late in a debt cycle. Look at the behavior, not the talk. Central banks bought about 863 tons of gold in 2025, even after buying heavily for years before that. That is not a retail craze. That is official money moving into an asset with no counterparty risk. Counterparty risk means the danger that the other side of the deal fails. Gold does not need another party to stay valuable. The same year, total gold demand pushed past 5,000 tons for the first time on record. Gold exchange traded funds took in about 801 tons. That means institutions were not just talking about uncertainty, they were positioning for it. At the same time, the average gold price for the year climbed to about $3,131 an ounce, and the fourth quarter average moved above $4,100. Numbers like that are not random noise. They show persistent pressure. And then there is the debt side of the picture. In the United States alone, net interest costs on the national debt reached about $970 billion in fiscal 2025, up from $345 billion in 2020. Think about that for a second. In just 5 years, interest costs nearly tripled. That is money spent just to carry yesterday's promises. The IMF also warned that global public debt was pushing above 95% of world output in 2025. World output is the value of what the world produces in a year. So the public debt load is now close to the size of almost everything the world makes in a year. That is not a normal background condition. That is a structural strain. When debt gets that large, every rate decision becomes political. Every budget becomes fragile. Every slowdown becomes more dangerous. And every central bank knows it. That is why I keep saying that the move in gold is not some old-fashioned fear trade. It is the market pricing the next policy response before the public fully feels it. Silver adds another layer to this story. Silver is part monetary metal and part industrial metal. That means people buy it both as a store of value and for real-world use in electronics, solar, and other industry. So when silver wakes up after gold has already moved, I pay attention for two reasons. First, it can signal that the monetary fear is broadening. Second, it can signal that physical supply is getting tighter. In 2025, the gold to silver ratio swung wildly. That ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. It moved above 100 for the first time since 2020, then later compressed to around 60 or below, the first time in more than a decade. That kind of move is not normal drifting. It is the market changing gears. When the ratio blows out above 100, it often tells me gold is getting the first wave of defensive buying, while silver is being ignored or treated as too risky. Then when the ratio collapses, it tells me the market has moved to the next stage. More participants are joining, more urgency is entering. The move is no longer just about safety at the top of the system. It is spreading through the rest of the market. If you have ever watched a fire move through a dry field, you know it does not burn every patch at once. One area catches first, then another, then suddenly the pattern becomes visible. Gold and silver often behave like that in late cycle periods. Gold catches first, silver confirms later. By the time silver confirms, the casual observer finally notices. By then, the signal is already older than it looks. I saw similar patterns in other periods when the system was under stress. In the 1970s, after the dollar's link to gold was broken in 1971, trust in paper money changed. That was a huge moment. The rules of money were rewritten. Inflation rose, confidence weakened, and gold eventually exploded higher. Silver followed with far more violence because silver is smaller, tighter, and more emotional. I also think about the 1930s. Back then, debt pressure and economic collapse forced governments into extreme policy action. The United States even changed the official price of gold. That was not about fashion. It was about the need to rework the system under severe pressure. When debt and political stress reach a certain point, governments do not protect the old rules. They change the rules. That is the piece many modern investors still do not understand. They think markets operate inside fixed laws. They do not. Markets operate inside political systems, and political systems change the rules when survival is at stake. That is why I spend so much time on incentives. Leaders will do what keeps the machine running for one more cycle, even if it weakens the currency over time. And right now, the incentives are plain. Growth is not strong enough to make the debt problem disappear. Cutting deficits fast would likely hurt voters and markets. Default would break confidence. So the soft path remains the likely path. More financial repression, more hidden debasement, and more pressure on cash and bonds in real terms. Financial repression means savers earn less than inflation for a long time. Here is a question worth sitting with. When was the last time you checked whether your portfolio protects your money or only your account balance? That may sound like a small distinction, but it is not. A person can look richer on paper and still be poorer in real life. If a portfolio rises 8%, but the currency falls hard and living costs keep climbing, the number on the screen can lie. Gold is not perfect, but it tends to expose that lie. It reminds people that what matters is not just nominal return, it is purchasing power. Now, I want to make this personal because systems only matter when they hit real lives. Imagine I am a careful middle-aged saver. I did the responsible thing for years. I put money into bonds, broad stock funds, maybe a little cash. I believed the safe part of my portfolio would stay safe, and I believed diversification would handle the rest. Then the world changes without asking me. The government needs to borrow more. Interest costs rise. Politics becomes louder. The central bank faces a slowdown and cannot stay tight forever. The currency weakens against hard assets. Suddenly, my safe assets are still paying me, but not enough to protect what those dollars can buy. I am not being robbed in an obvious way. I am being diluted slowly. That is the environment where gold starts to make emotional sense, even to people who used to mock it, not because they became gold bugs. I never liked that kind of tribal thinking anyway. They move because they finally understand that a piece of their wealth should live outside the chain of political promises. Silver then attracts the people willing to accept more volatility for more torque. And yes, silver is far more volatile. Volatile just means it moves around more, both up and down. That is why I never treat silver like a calm reserve asset. I treat it like a smaller, sharper expression of the same message mixed with industrial pressure. It can lag badly. It can overshoot wildly. That is exactly why the gold-silver sequence tells me so much about market psychology. Some people will object here and say, if this signal is so important, why have stocks also gone up at times? The answer is that late cycle markets often lift many assets together for a while. Liquidity can do that. Liquidity is extra money and credit flowing through the system. It can raise stocks, real estate, gold, and even bad ideas at the same time. That does not disprove the signal. It often confirms the stage. Other people will say gold and silver do not produce cash flow, so why own them at all? That objection is fair, but it misses the role these assets play. I do not look to gold to produce income. I look to it to hold value when income-producing assets are being repriced by weak money, policy rescue, or system stress. In other words, I do not ask my house insurance to pay a dividend. I ask it to work when the storm hits. There is also a geopolitical layer now that investors cannot afford to ignore. The world has become more fragmented. Sanctions, trade fights, reserve seizures, military tension, and bloc politics have all made countries think harder about what they own and where they store it. When nations fear that reserve assets can be frozen or weaponized, they look for something neutral. Gold benefits from that. Silver, in a different way, can follow when private capital takes the hint. I have used the phrase capital war because that is what this starts to resemble. A capital war is not tanks rolling across a field. It is a struggle over where money goes, what money can be trusted, and which assets are politically safe. In that kind of world, reserve managers, sovereign funds, and institutions do not think like retail traders. They think in decades. And when they shift, they can shift the ground under everyone else. The public usually notices this too late because the headline story always sounds smaller than the structural story. The headline says gold is rising on fear. The structural story says the people who understand debt and power are adjusting to a world where promises have become more fragile. The headline says silver is breaking out. The structural story says the message has broadened beyond the first layer of buyers. If that deeper layer is useful to you, keep coming back to this conversation because most mistakes in investing happen when people react to the headline and miss the mechanism underneath it. Now let me address one more skeptical view. Some investors think this move is already too crowded. They look at strong prices and say the easy money is gone. Maybe. That can happen. Metals can correct hard, sometimes brutally. Gold can fall even in a bull market. Silver can fall twice as fast. I never forget that. But a correction in price is not the same as a correction in the underlying cause. The underlying cause remains debt stress, weak fiscal discipline, reserve diversification, and political pressure on central banks. None of those have been solved. In fact, many of them have grown worse. That is why I separate the trade from the signal. The trade can get crowded. The signal can still be early. Investors who mix those two ideas often get whipsawed by short-term moves and miss the long-term shift. So what could happen next? I see at least three broad paths. In the first path, growth slows just enough to force easier policy, but not enough to cause a deep crisis. In that world, gold can stay firm because rates come down and debt remains high. Silver can do well too, especially if industrial demand stays healthy. This is the cleaner version. In the second path, inflation stays stickier than central banks want, while growth also weakens. That is a messy combination. It traps policymakers. If they cut too much, they risk weaker currency and hotter inflation. If they stay too tight, they risk market stress and recession. In that kind of squeeze, gold often does very well because it thrives when trust in policy skills starts to erode. Silver can be more erratic, but if the move broadens, it can sprint. The third path is the one people least enjoy imagining. A deeper credit accident hits somewhere important. That could be in sovereign debt, private credit, banking, or a geopolitical shock that disrupts capital flows fast. In that case, almost everything could sell off at first because investors rush for cash. But after that first liquidation, policymakers would likely respond hard, and that response could become fuel for the next leg in precious metals. Notice what all three paths share. None of them require a fairy tale. None of them require gold to become the daily money in your pocket. None of them require the end of civilization. They only require what history has already shown many times, which is that heavily indebted systems eventually lean on weaker money to buy time. That is why I think many investors still read this wrong. They think gold and silver are sending a message about a mood. I think they are sending a message about a structure. Mood changes fast. Structure changes slowly, then all at once. By the time the average investor feels the structure, the market has usually been signaling it for months or years. So what do I do with that? I stay balanced, but I do not stay blind. I have long believed that a prudent portfolio can hold some gold, often somewhere in the range of 5 to 15%, depending on the person and the environment. Not as a religion, not as a gamble, as a way to reduce dependence on a single monetary system. Silver, for me, is a more tactical piece, smaller, rougher, and deserving more caution. If you own no hard assets at all, you are making a very big bet, whether you realize it or not. You are betting that debt can keep rising without damaging money. You are betting that policymakers will handle every trade-off cleanly. You are betting that the reserve system will stay trusted even as geopolitics gets rougher. That is a bigger bet than most people think they are making. And if you do own gold or silver, the lesson is not to become smug. The lesson is to understand why you own them. If you own them for the wrong reason, you will sell them at the wrong time. If you own them because you understand the cycle, you will not need a perfect headline to hold your ground. Conviction comes from clarity, not from price action. So when I say gold and silver just sent a signal most investors missed, I am not talking about a chart pattern in isolation. I am talking about the chain of events behind the chart. Central banks buying, debt costs surging, public finances straining, the dollar's dominance getting questioned at the margin, gold moving before the crowd, silver answering after the warning had already been issued. That is a system-level message. It says the guardians of large capital are no longer treating paper promises as enough. It says neutral stores of value are being repriced. It says trust is being redistributed slowly but clearly. And when trust starts moving, prices are only the surface. I have seen this enough times to know that people always want the moment of danger to look dramatic. Usually it does not. Usually it begins with quiet shifts in incentives, quiet changes in allocation, and quiet moves in assets most people stopped taking seriously years ago. Then one day, the public looks up and calls it sudden. It was not sudden. It was building in plain sight. Gold saw it, silver confirmed it. And if you miss that message, do not just chase the price, study the reason. Because in the end, the biggest losses rarely come from what we fail to buy. They come from what we fail to understand. When trust begins to leave paper, hard money stops being a trade and starts becoming a verdict.